I screened every Dividend Aristocrat stocks through my 3 metrics. All 65 of them, at least based on this website. If you haven't seen my previous videos, I do screen stocks through my 3 metrics to see whether a stock is trading at overvalued, fair, or discounted prices. From there, we should see if the stock is a buy or not at the current prices. I am a long-term investor. I want my money growing, and I like me some dividends. This website was a huge help in a way that it gave me a full list of companies I might want to invest my money in. According to Investopedia, a Dividend Aristocrat is a company in the S&P 500 index that not only consistently pays a dividend to shareholders, but annually increases the size of its payout, and if they've done it for the past 25 years. Crazy. I use my 3 metrics to screen stocks through their financials. As a long-term value investor, we don't want to be overpaying for stocks. We don't want to be buying a dividend trap, and we don't want to be buying just any stocks with a high dividend yield. Their financials must back the current price, their dividends, and they must be buying back shares as we want to own a larger piece of the pie as time matures. Buying stocks at the right prices will help me sleep well at night, knowing that I bought a stock with the process and that their financials confirm it. I don't really care if the stock price goes down. That time, I'd buy more. I'd own more, as long as their financials remain healthy, reasonable, and still continues to confirm your process and thesis. Continue adding, and you'd do well in the long run. In this website, you'd see here your favorite dividend stocks, like APD, M, ABBV, ADP, CAT, GPC, IBM, all of them. But obviously, some of them have already priced in years of growth, as they are overvalued or overowned. So screening them would help you avoid owning or buying those stocks. Before anything else, the data I used here was sometime in March 18, 2022. It was trading hours then, so obviously the stock price had moved, but not by much that it would alter these results. This here, in the far left, is my first metric. Don't worry, I'll upload it. It's a little messy though, but it should work. My first metric, we want an EPS multiple less than 3. EPS multiple is PE divided by the EPS. PE is the price we pay for in a stock, not the stock price. The stock price is a measure of their valuation, not a company's performance. This metric tells us how much we're paying for in a stock at the basis of their earnings. This also gives us a sense of how much shares they're buying back, and if it's enough to increase the EPS, especially if they're not growing their revenues anymore, because most of these companies are old. You'd see here the ticker symbols, the prices when I screen them, and their respective PE. And you see here also the EPS trailing 12 months. Again, EPS multiple is PE divided by the EPS. We want a multiple less than 3 because we don't want to be overpaying for a stock. The multiple must only be 3 or less than 3. The remark here, proceed to next metric, is if the multiple is less than 3, and avoid for stocks with more than multiple of 3. This doesn't mean that the other stocks are not a buy, but what we want is this perfect ratio between what we're paying for, or the PE, by the EPS the company reports. Stocks with high multiples means we're paying more than thrice their EPS. What we want is for them to increase their EPS by buying back more shares. At some point in time, they'll change and maybe we'll be a buyer of those stocks, but not for now. Of the 65 stocks, only 23 stocks are worth looking at their financials. That's 35% of the Dividend Aristocrats. We'll move on to the next metric. This is my second metric. When you compare this table to my previous videos, it's not the full picture. I did not include the COGS and operating expenses. But what's important here is their yields. Second metric, we want to pay $1 or less for 1% of the money they're making. This means we're paying 1 PE for 1% of their yields. This metric tells us if the stock is trading at overvalued, fair, or discounted prices. If the multiple is above 1, it is overvalued or overowned. If it's below 1, it's undervalued. If it's around 1, say 0.95 to 1.05, it's at fair values. We don't want overvalued stocks. What you see here is revenues deconstructed. This is the net income and free cash flow they generate off of those revenues. The values are in billions. Below is their yields or margins. This is in percentages of their respective revenues. I'll show you the relationship of the cells. We'll take the lowest yield of the four highlighted values to divide our PE. Why the lowest? We want the lowest yield because that would be the base of our assumptions. This is when you buy a stock. You buy the stock at their lowest yield, not at the highest. I did this to all 23 stocks, and only 9 stocks passed. Of the 65 stocks, we're down to 9 stocks. That's 14% of the Dividend Aristocrats. These are the 9 stocks: MMM, AFL, CB, CINF, BEN, MCD, NUE, SPGI, and TROW. Now, I did not include my third metric, which is the historical PE, because we're not really looking for the best entry prices for the stock for now, and we're not confirming our entry PEs for the stock. After this metric, we need to dive a little bit more. We need to look at their sectors. Why? Some sectors trade at low PEs for some reason. If we look here, you'd see here insurance or financial stocks. These stocks trade at a low PE because their company is customer based. If the customer decides to take out their money, that's less revenues for them. And those are things they have no control over. And that's why the markets are pricing these stocks at a low PE. I personally don't want to invest in insurance, so we'll cross them out. But if you want to invest in them, why not take on the highest yield of them all, which is AFL? Next, I won't be investing in NUE because it's a company that is relying solely on the price of the commodity. If the commodity price plummets, the stock plummets. You want to invest in these companies at a very conservative PEs. But if you're really for the dividends, go invest in NUE. So guys, this is what we're left with. And these are the only stocks I'd recommend you buying. Forget everything else. Put money on these stocks every paycheck. But wait, after you've seen their fundamentals and other important financial ratios, you also want to check their debt levels. Add when the stock falls on everything. Of the 65 Dividend Aristocrats, I'd only invest in 4 of them. These are 3M, McDonald's, TROW, and BEN. 2 asset management, 1 consumer cyclical, and 1 industrial. You can see for yourself these other 5 stocks here, but I won't be touching them. All in all, only 6% of the Dividend Aristocrat is what I'm looking to put my money in, at least this time. That's 4 of the 65 aristocrats. This 3 metric I use is designed to determine the best PE to buy a particular stock, as I believe PE is the price you pay for in a company. This is my process of screening stocks to buy at what PE by looking purely at the company's financials and none of their fundamentals. If you like to invest in these companies, I'd advise you to look at their fundamentals, their charts, and more of their financial data and metrics like long-term debt, some important financial ratio, etc. As always, do your own research.